Now, the use of joint names on accounts or properties are extremely common in Canada and not just limited to spouses. We often see this between parents, children, family members, and even business partners. Now, for the longest time, this has been a tricky topic because sometimes it can lead to taxations, income attributions, or an outright estate settlement problem. But this strategy is about to get a lot more complicated or expensive because of the new tax rules that CRA have implemented last year. So today I'm going to give everyone a rundown of what these new rules are, if you're included, if you're affected, and when you should be talking to a CPA or a planner about your situation. Now, everyone should be watching this video because if you're in this situation, you actually don't have a lot of time to resolve this before you start incurring penalty, and the penalty, as we can see, will get very, very expensive. So not only watch this, but also share with any friends or family that may or may not have a joint account right now with their family members. Alright, without further ado, let's dive into today's video. Alright, so the new rule we're looking at here is basically requiring all trusts, except for a few exceptions, to file something called T3 Trust Income and Tax Information Return and disclose beneficiaries along other info. Now, this rule originally is aimed to target Canadians that are using trusts on purpose to skirt taxes or do something very shady. And by here, you might be hearing the word trust and think, we should be safe because we don't have a trust going on. Well, not quite, and that's the whole point of this video, because you might be in a trust without knowing you're in one. See, in Canada, there's something called a bare trust. This is where the settlor, aka the original owner, transfers the title to a trustee to hold title for the sole benefit of the beneficiary, which is often the settlor themselves. And as long as the trustee can only act in the direction of the beneficiary, this is a bare trust. Alright, so in plain English, basically if I ever have an asset, if I transfer some or all of it to another person to be on title, but that person cannot act unless I give instructions every time, this is now a bare trust. Now, there are three common scenarios of when a bare trust can be created in Canada through day-to-day transaction, basically. Now, the first example is when elder parents bring their kids on board to be on joint account to help with day-to-day banking and transaction, etc. This is also called P-Core Trust. As a side note, if you're wondering why it's called P-Core Trust, it's because there has been a lawsuit between the family of P-Core when the ex-husband sued the wife for half of the bank account because her name is on there, even though the money doesn't belong to her but belongs to the parents. I've linked that in the description below. At the end, the husband didn't get anything because this is actually considered as a trust, not an actual joint account. You can find the article in the description if you want to read more. It's an extremely interesting estate lawsuit. Now, the second example is when parents add their own name on title to own a property with their kids together because their kids could not qualify for mortgage, so they're helping out as a co-signer. But if the parents can't do anything to the property without kids' instruction, this is now a trust. This is something we see a lot as well. Often clients say, what if I add 1% onto the property I bought for my kids, so then the partner can just move in, be on title and split everything, etc. You may have entered yourself into a trust without knowing so. And then lastly is maybe a joint account between spouses, and this one we need to be more careful because if we read the description of what constitutes as a bare trust, if you replace everything, the word children or parents with spouse, then actually that works as well. So if you add a spouse onto your account for whatever purpose, but the spouse can't do anything unless you give them the instruction they're okay to, then this actually constitutes as a bare trust. Now, this one I think is less common to count as one because there's a lot more reasoning to add a spouse onto the account and make decision jointly. So I'm not too worried about this. I'm more worried about the first two examples. Alright, so now we've set up a bare trust without knowing. So what is the tax consequences since it sounds so bad? Well, there's actually no tax consequences most of the time for these kind of trusts because if there's ever any, you would have incurred that already when you transfer your title to someone else or when you add them to the joint name. So any tax consequences would have been cleared already. Alright, so what is the problem? The problem with these rules is not the tax itself, but the requirement to report it on your tax filing. Now, because of this new laws, if you have a bare trust going on, you have at most 90 days after the year end to report this trust on the T3 Trust and Income Return. And the penalty of not reporting the trust can be very severe. it is actually $25 per day that is late on filing, with a minimum charge of $100 and a maximum charge of $2,500. Now, if your failure to report is more of an intentional thing or gross negligence, then it's going to be 5% of the maximum value of the account or property we're looking at, whichever is higher. So as you can see, this is why it can get extremely expensive. So imagine if you're on joint account for your elder parents for 4 bank accounts. That's 4 different reportings you have to do. And if my understanding is correct, if you fail to report them, it could be upwards of $2,500 per account. So you're looking at $10,000 in total for penalty. Quite a bit of Canadians are actually in this bear trust setup without knowing so, and I doubt any of them will know they have to report starting this year. So this is why I say you should watch the full video yourself and also share this to your friends and family in case they're in a trust situation. So with that being said, let's talk about solution. There are a few things we can do to help ourselves now and in the future. Now before we do that, as a reminder, make sure you like this video. This can really help us, and also join our private Facebook group if you haven't already. We have over 5,000 members. In there you can ask more questions or get more content. So the first thing is obviously consult a CPA or planner as soon as possible if you believe you may be in a trust situation. How can you tell? Again, if you are ever added title or transfer on title to hold on to something for someone, and it's really for the purpose of ease of access, skip probate fee, etc., but you really can't make any decision unless that person gives you the okay, that is a trust situation. Now secondly, obviously, is to avoid putting yourself or anyone else in this trust situation. Now you may say, but I do need to use a joint account because of ease of access or whatever. There are actually ways to get around this. For example, if it's the elder parents and the children situation where you're helping the elder parents, use a power of attorney. This will give you full access to the account to do the same thing as you have always been doing without putting yourself on title. If a parent is helping the children out with mortgage approval, be a guarantor instead of co-signer. Guarantor doesn't put you on title, whereas co-signer does, but it still gets the job done. And lastly, for spousal situation, this is not very common, like I said, but if you ever think you're running into one for investment purpose, you're on a joint account, maybe consider doing something like a spousal loan agreement. That way, the lower income spouse can be 100% ownership on there, and then you have less chance of running into this joint trust weird, awkward situation. And again, I want to reiterate, this is probably not something you want to handle yourself. So if you ever suspect you or your family member may be in this situation, consult a CPA, consult a planner, get these things figured out because you have only 90 days since 2023 to report this T3 return. Alright, so that's it for this week's video. This is a quick rundown of this new rule that a lot of Canadians have missed, I'm sure. If you have any questions, comment down below. I'll try my best to answer them. Also, if you like these kind of videos, I do upload them bi-weekly, so make sure you subscribe to the channel, click the bell button to get all the notifications in the future. Next video, likely what I might be talking about is probably inflation, interest rate, and also the housing market. So make sure you stay tuned if you like that. As always, it's Jacky. Thank you for watching. I'll see you in the next video. Bye!